But this isn't a headline, it's a siren. The most powerful military in the world has just made a move so silent, yet so aggressive, that it confirms what the insiders feared most. The silver shortage is not a theory, it's a battlefield. A $7.4 billion smelter, a 40% Pentagon stake, and the same bank that shorted silver for decades is now hoarding it behind closed doors. This isn't about price anymore, this is about possession. And what happens next will determine who controls the supply chain of the future and who gets left with nothing. Welcome to the channel. This is John A.G. from Currency Archive 2. If you're watching this and you over 50, done just scroll like the younger crowd. Hit subscribe the way you'd lock your safe at night. Also, tell me below, where are you tuning in from? I want to know where this global silver story is reaching. The warning did not come through a press conference or a dramatic speech. It came quietly, buried inside a funding decision that most people ignored. While markets focused on technology stocks, digital currencies, and interest rate debates, a different kind of signal appeared, one that spoke to physical limits rather than financial theory. The United States government committed $7.4 billion to secure silver supply through a critical minerals processing facility. To those who understand power, this was not a routine investment. It was an admission. For decades, silver had been treated as an afterthought. It was called a commodity, a byproduct, or even an outdated form of money. Policymakers spoke as if supply would always be there, ready when needed. But silver is not software. It cannot be printed, coded, or created with policy. It must be mined, refined, and physically delivered. And suddenly, those responsible for national defense appeared to realize this truth all at once. The decision to spend billions was not driven by profit. Governments do not invest like private funds. They invest when something is missing, threatened, or becoming unreliable. In this case, the concern was not price volatility. It was availability. Silver sits quietly inside modern civilization, powering systems people rarely think about. It conducts electricity in defense systems, stabilizes communication networks, and enables advanced weapons technology. Without it, entire systems fail. For years, the United States depended on global supply chains to deliver refined silver. Ore was mined in one country, processed in another, and shipped across oceans before reaching factories and military suppliers. This system worked when trade was stable and trust was intact. But trust is no longer guaranteed. Trade routes are now political tools. Export restrictions appear without warning. Strategic materials are being held back, not sold freely. Those watching closely noticed something unusual about the new project. The government was not simply buying silver from the market. It was securing ownership over part of the production process itself. This marked a shift from buyer to controller. When a state moves upstream into processing and refining, it signals a deeper concern. The market can no longer be relied upon to deliver what is needed in a crisis. The timing matters. The investment came as global demand for silver was rising, not falling. Energy transitions, digital infrastructure, and defense modernization all require more silver, not less. At the same time, mining output has struggled to keep pace. New mines take years to develop. Environmental rules slow expansion. Political instability disrupts supply. The gap between demand and reliable supply has been growing quietly. Most people only notice shortages when shelves are empty. Governments notice them earlier through data and internal forecasts. They see inventory levels, delivery delays, and failed contracts. They see what happens when multiple buyers compete for the same limited supply. When industrial users begin to bid against military needs, price becomes secondary to priority. Whoever controls the metal controls the outcome. This is where the $7.4 billion decision becomes important. It was not made to influence prices on a screen. It was made to ensure physical access. The government chose to spend real money, build real infrastructure, and secure real output. That choice reveals fear, not panic in the emotional sense, but strategic urgency, the kind that appears when planners realize the margin for error is gone. The public narrative still speaks of stable markets and normal conditions, but actions tell a different story. When a government prepares for scarcity, it does not announce weakness. It moves quietly and early. It locks in supply before others understand what is happening. By the time the public notices, the critical assets are already spoken for. This first move also sends a message to large financial institutions and industrial players. The state is no longer assuming the market will solve the problem. It is intervening directly. That changes behavior across the system. Companies begin to secure long-term contracts. Banks reassess risk assurance. Industrial buyers start building buffers instead of relying on just-in-time delivery. The scramble begins not because of headlines, but because of observation. Silver, once dismissed as abundant, is now being treated as strategic. This reclassification does not require public declaration. It shows up in budgets, facilities, and ownership structures. The moment defense planners assign priority to a material, it exits the world of speculation and enters the world of control. For the business community and serious decision makers, this matters deeply. When governments move first, they reshape markets quietly. Entrepreneurs who wait for confirmation often arrive too late. The lesson of history is simple. Follow actions, not words. Money can be printed, promises can be changed, but physical resources obey only geology and logistics. The $7.4 billion investment is not an isolated event. It is the opening move in a larger shift. The scramble is not emotional, it is structural. And when structures begin to change, everything built on top of them eventually follows. While the headlines barely noticed the $7.4 billion smelter announcement, something far more alarming was happening on the other side of the world. On January 5th, 2026, the Shanghai Futures Exchange showed silver trading at $82 per ounce. On that same day, the COMEX price in New York hovered around $75. This wasn't a minor price fluctuation. It was a 7 spread on the same asset, a crack in the global pricing system that had remained stable for decades. To someone unfamiliar with commodity markets, a $7 price difference might not seem important. But in global trade, such a spread is massive. In fact, it signals a complete failure in the normal pricing mechanism. Silver has always traded with tight margins across exchanges. Arbitrage, the act of buying low in one market and selling high in another, would normally eliminate such a gap instantly. But this time, that didn't happen. The gap didn't close. It widened. Why? Because the paper markets in the West, particularly COMEX in New York, are no longer setting the real price of silver. Instead, they are reflecting contracts, not physical metal. In these markets, large banks and financial institutions trade billions of dollars worth of silver exposure through futures and options. These contracts are often cash settled. Most never result in delivery. It's a financial game built on promises. But in Shanghai, the price reflects something different, real metal changing hands. Buyers there want physical silver. They want it for factories, electronics, solar panels, and industrial stockpiles. And they are willing to pay a premium for guaranteed delivery. That's the key. In China, people are not bidding on paper. They are bidding on atoms. This divergence matters because it marks the breakdown of the global silver pricing system. For over 50 years, New York and London set the benchmark. Their prices influenced global trades, institutional strategies, and even central bank policies. But now, those prices are being rejected. Shanghai has effectively stood up and said, "We don't care what COMEX says. We need the metal. And we're willing to pay more." The result is what analysts are now calling a dual price regime. One price is based on futures contracts, promises to deliver metal someday. The other is based on real-time physical settlement, metal delivered now. The first is heavily influenced by trading algorithms, leverage, and speculation. The second is grounded in need, scarcity, and delivery risk. This fracture is not theoretical. It has real consequences. Global traders, hedge funds, and commodity houses are watching this $7 spread and making decisions. If you own physical silver in London or New York, do you sell it locally for $75 or ship it to China for $82? The math is simple. You sell where the bid is higher. This creates a powerful vacuum. Silver begins flowing from west to east, from Western vaults to Asian refineries, from COMEX registered inventories to industrial consumers in China. This silent migration drains physical supply from Western financial hubs, and there's very little the U.S. government can do to stop it. That's why the Tennessee smelter matters so much. It's not just about increasing production, it's about keeping the metal. If the government doesn't build a domestic processing hub, the ore from Latin America will continue flowing to Asia. The Pentagon is not reacting to a shortage today. It is preparing for an absolute lack of availability in the near future. Consider this. For decades, silver mined in Mexico, Peru, and Bolivia was shipped across the Pacific to Chinese refineries. There, it was processed, used, or stored. But once refined and stockpiled in Asia, that silver rarely comes back. The U.S. realizes it has lost control of the midstream, the crucial processing stage between mine and market. And now with the Shanghai premium rising, China is doubling down. They're paying miners in yuan instead of dollars. They're offering long-term contracts that guarantee favorable terms. They're locking in physical supply through forward delivery agreements. In simple terms, they are doing exactly what the Pentagon is doing, but on a much larger scale and much earlier. For entrepreneurs and strategic decision makers, this should raise critical questions. If global pricing is breaking down, how reliable are the signals coming from Western markets? If supply is migrating, how long until Western industries face serious disruptions? This isn't just a problem for investors. It is a risk to any business that depends on high-purity silver. From aerospace to medical equipment, from semiconductors to energy storage, if the dual price system becomes permanent, it will introduce cost uncertainty, sourcing risk, and operational delays. No business wants to be caught negotiating for metal during a geopolitical supply crunch. The price fracture is a warning, not just for governments, but for every sector that relies on inputs from the physical economy. It tells us that faith in old systems is fading. It signals that pricing power is shifting to those who control delivery, not just contracts. And most of all, it confirms what the $7.4 billion smelter already implied. They are scrambling, not for profit, but for survival. Part 2 reveals the deeper mechanics behind the scramble. It's not just about production, it's about location, ownership, and trust. In the next part, we'll examine the unexpected pivot of a major financial institution, one that once led the charge in suppressing silver prices and is now moving to control the flow of metal itself. The question is no longer who holds the contracts. For nearly 2 decades, JP Morgan was viewed as the chief architect of silver price suppression. Traders, analysts, and researchers accused the institution of holding massive short positions on the COMEX futures exchange, positions so large they often exceeded available physical supply. Regulatory investigations confirmed that spoofing and manipulation did occur, but the penalties were minor, the profits enormous. And for years, JP Morgan treated silver not as a scarce asset, but as a controllable number on a screen. But now something has changed. The same institution that once held the largest paper short position in silver history is financing the construction of America's most significant physical infrastructure project in metals in half a century, a $7.4 billion smelter in Tennessee. One designed not just for zinc, but for a broad array of critical minerals, including silver. This is not a coincidence. It is a pivot. It's one thing for a government to panic and seek national resource security. It's quite another for a bank like JP Morgan to fundamentally shift its business model. That shift signals not just a changing market, but the death of an old strategy. The paper game is being abandoned, not in public statements, but through real capital deployment. To understand the magnitude of this move, we must look at incentives. JP Morgan is not a charity. It does not fund long-term infrastructure out of goodwill. The decision to co-finance a smelter represents a bet that physical control will be more profitable and more protective than financial manipulation in the years ahead. The Tennessee facility is specifically designed to process 1.1 million tons of raw ore each year. It will extract 13 metals deemed critical by the U.S. Geological Survey. But what sets this project apart is its ownership structure. The U.S. Department of Defense will hold a 40% equity stake. That alone confirms the strategic nature of the operation. But behind the government's involvement, JP Morgan plays a quieter role, the financial and logistical facilitator. They're not just writing checks, they're designing supply chains, negotiating offtake contracts, and likely securing pre-arranged access to the output, especially silver. This positions the bank not as a speculator, but as a gatekeeper of the Western Hemisphere's silver flow. It's a strategic pivot from betting against price to controlling delivery. Why would they do this? Because the old game, manipulating price through leveraged paper positions, is now deeply risky. As physical silver becomes harder to source, holding a short futures position could become a liability, not an asset. If the price of silver spikes to $200, paper shorts must cover, often at enormous loss. But if you control the smelter, you control the metal. The risk is reversed. This is what JP Morgan has likely concluded. In a world of structural scarcity, the winning position is no longer to bet against silver. It is to own the flow of silver, regardless of price. The strategic implications are vast. JP Morgan already has deep ties in Latin America, where most of the world's silver is mined. The new Tennessee smelter is specifically configured to process concentrates from Mexico, Peru, Bolivia, and Chile. Previously, this ore was shipped to Chinese smelters for refining, but now the U.S. is creating an interception point, an attempt to reroute the flow northward and cut China out of the middle. By financing this pivot, JP Morgan secures first access to refined output before it ever hits the open market. This includes silver bars destined not for COMEX warehouses, but for strategic buyers. The Pentagon, defense contractors, industrial giants. These relationships are governed not by market prices, but by locked contracts, delivery priority, and long-term supply security. JP Morgan becomes the toll booth operator. Every ounce processed through that smelter may carry their financial imprint, whether through hedging, warehousing, or off-market distribution. In short, the flow of silver is being privatized. This raises an important point for entrepreneurs and institutional players. The silver market is fragmenting. There will be 2 classes of participants, those with direct access to physical flow and those left with screen-based exposure. The second group will trade contracts. The first group will hold actual inventory, and JP Morgan has made its choice. This is not an isolated case. It is part of a larger institutional trend. Sovereign wealth funds are accumulating metal. Central banks are increasing gold reserves. Industrial users are striking private deals. And now, one of the largest global banks has transitioned from suppressing the price of silver to building the infrastructure that controls it. This is not just a pivot, it is an exit strategy. An exit from the paper game they helped create. A move to safety before volatility renders that game unplayable. Their actions also expose the growing irrelevance of the futures markets. COMEX may still show a price, but real silver increasingly is being moved, refined, and stored off exchange. When the largest short player in silver history no longer wants to play the game, it should raise alarm bells across the financial world. In the next part, we will explore what this means for the future of price discovery. If COMEX becomes a ghost market and real metal trades through private contracts and government-controlled flows, then price will no longer reflect value. It will reflect access. And access, as JP Morgan now understands, cannot be printed. It must be built, or bought, or secured before it's gone. By the time the public begins to notice shortages, the decision makers have already moved. They have acted, built, financed, and secured what they need long before prices rise or headlines warn. The Tennessee Smelter Project, co-funded by the U.S. Department of Defense and JP Morgan, is not merely a supply chain investment. It is a clear signal that the global silver market has changed permanently. At the center of this shift is a structural truth. The global pricing mechanism for silver no longer reflects true market dynamics. For decades, the COMEX Futures Exchange served as the reference price for silver worldwide. Traders, manufacturers, and even governments relied on it to make decisions. But in 2026, a new force has emerged, the Shanghai Premium. A second price, higher and more persistent, set not by contracts, but by delivery demand. This price divergence is no longer an anomaly. It is becoming the new normal. Shanghai is bidding $82 for silver. COMEX remains below $75. The spread is not closing. And that tells an uncomfortable truth. The paper price is broken. A functioning market cannot sustain two prices for the same asset in different regions without arbitrage eliminating the gap. Yet this arbitrage has failed. Why? Because the silver in Western vaults is no longer freely available. It is either leased, rehypothecated, or encumbered. The metal that once backed futures contracts is no longer deliverable at scale. In contrast, the Shanghai market deals in physical settlement, and the demand there is real, urgent, and growing. This shift marks the slow collapse of a decades-old financial illusion that paper claims are equivalent to real metal. In calm conditions, this illusion held. Traders accepted that futures contracts, ETFs, and unallocated silver pools could be redeemed or settled without issue. But in a world of rising geopolitical tension, trade restrictions, and physical scarcity, this assumption no longer holds. The implications are significant. As more institutions begin to question the reliability of paper exposure, the desire for direct access to physical metal increases. This is already happening. Central banks are increasing precious metal reserves. Sovereign wealth funds are striking long-term supply deals. Large industrial buyers are bypassing exchanges entirely, negotiating directly with miners and refiners. Even defense departments, such as the U.S. Pentagon, are no longer willing to rely on the market. Their actions speak clearly. They want control, not exposure. They are securing supply chains from the ground up. They are entering joint ventures, taking equity stakes, and building facilities that guarantee access regardless of market price. This is not speculation. It is strategic necessity. For entrepreneurs, business owners, and institutional investors, the lesson is sobering. The age of trusting the screen is over. The digital price of silver, shown on trading platforms and financial news tickers, may no longer represent availability, reliability, or security. The real value is shifting to the physical layer. The atoms, not the abstractions. This is where access replaces price. In such an environment, possession becomes the final arbiter. Whether the price is $75 or $100 becomes irrelevant if the metal cannot be acquired when needed. A manufacturer without silver cannot meet contracts. A defense supplier without critical inputs cannot fulfill national obligations. In this sense, the market is undergoing a silent repricing, not in dollar terms, but in strategic priority. The Tennessee Smelter is a symbol of this shift. It represents the formal beginning of resource isolationism, a move away from global reliance toward regional control. Not because globalization has failed in theory, but because it is no longer reliable in practice. When tensions rise, contracts are ignored. When shortages emerge, exports are restricted. In this world, the ability to refine your own ore is not a luxury. It is a form of economic sovereignty. That is why JP Morgan's pivot matters. The institution that once profited from the opacity of futures contracts now wants front-row access to the flow of real material. They are securing throughput. They are embedding themselves in the very infrastructure that governments and industries will rely on when paper markets lose relevance. The message is clear. Those who control the flow will set the rules, and the rules are already changing. COMEX and LBMA may continue to publish prices, but fewer market participants will base their decisions on them. Instead, they will look to off-market contracts, physical premiums, and regional availability. In time, the financial world will split into two layers, a public layer of data and a private layer of delivery. This moment creates both risk and opportunity. Those who continue to rely on outdated models of trust and exposure will find themselves blocked, delayed, or priced out. Those who adapt early, by building physical relationships, securing long-term contracts, or acquiring tangible assets, will be positioned to survive and lead. In the end, the panic that led to the $7.4 billion silver smelter was not rooted in fear. It was rooted in knowledge, the knowledge that the old system could not deliver when it mattered. That markets could be manipulated, but nature could not. That contracts could be rewritten, but missing resources could not be replaced. The U.S. government, the Pentagon, and J.P. Morgan have now shown their cards. They are no longer playing the futures game. They are building a future where possession is 100% of the law. In such a world, physical assets are not investments. They are lifelines. And those who understand this shift will not watch the next crisis unfold. They will already be prepared for it.